Okay, welcome everybody to an exclusive episode of the Joseph Carlson Show. I know this is a bit different. I normally don't have the camera, but I thought, why not just use the webcam this time? I might show it from time to time, but I still am going to show my screen for the majority of the time. Now, if you're new to the Discord and you're new to the exclusive episodes, first of all, thanks for joining and trying this out. We always have a lot of new members. So if I go to new members here, we had a number of people join today and people all throughout the week. So all of you, I know that you're trying out the free trial. I know that this is all new. It's a lot to take in if you're just joining. Just give it some time. Hang around for a week or two. You'll get charged at the beginning of the month. So you can figure out then if it's something that you think is worthwhile. But we're doing a lot of things on this to try to add value. One of them is that I'm working on the portfolio tracker called Qualtrim. So this is an ongoing project. I have a full-time, he works on it every single day. It's somebody that I've worked with before. It's a senior level developer that's helping me build Qualtrim, which is the portfolio tracker. So we are doing a lot of work on that. I know we haven't pushed out an update recently. But that's because the project we're doing with Qualtrim right now is pretty in depth. We're basically taking a web application. So it's all on the desktop and you can view it on mobile, but it really looks best on the desktop. We're taking that and we're putting into native iOS and Android. So that's a pretty big undertaking. We want to do it right. We're making progress on it. We should have some beta testing for the iOS app and the Android coming up pretty soon. So that's the update on Qualtrim. But if you haven't tried this out, it's kind of a dividend tracker, but we didn't want to make it just solely focused on dividends. I want it to be useful for people that are focused on growth as well. So this is something that's going to be an ongoing project. I'm going to continue to look at the feedback you guys have, fix different bugs with it, push out new features, and it's just going to be something we work on throughout time. So that's the update on Qualtrim. We're still trying to get that into mobile. It's probably going to take a few more weeks to get it completely polished. And then after that, we can start going through the other feature requests. Other things to point out, if you're new to the Discord, check out the exclusives channel. That's the channel right here under trades. This exclusives one is all the content that I don't have on my main channel. So all these episodes are completely free. You can go through them and watch all of them while you're a member of the Discord and the Patreon. And one of them has this one's actually a write-up. What is the story fund? This gives you the basis of what the story fund is, what I built this portfolio with. That's the portfolio right here. This is a story fund. I've been funding this $500 a week, so about $2,000 a month. The returns have been really good so far. So if I look at the returns compared to the S&P 500, this is what it looks like so far. It's beating the S&P 500 since day one of starting this. I started tracking it right away. It's something that a lot of people want me to do with the passive income portfolio. Unfortunately, I did not set up the passive income portfolio, first of all, to even compete with the S&P 500. That wasn't something that was really my goal at the time. And I didn't track it against the S&P 500, and it would be very difficult to do right now. I can do some rough estimates. Like I can look and say, hey, if I go to the passive income account and I look at the past year, I'm up 18% money weighted. Then I can go to SPY. I can say the S&P 500 is up 14%, so 18% against 14. I might be beating the S&P 500, but that's not really a fair comparison because I've been buying all throughout this dip. And if I did the same with the S&P 500, maybe it would have better returns. I don't really know. So it's very difficult to compare, but that's what I made this special spreadsheet for. If I look at this spreadsheet, this compares the S&P 500 against the story fund. Right now, the story fund has returned 16.34%, while the S&P 500 has returned 10%. So we're beating it by a little bit. Anyway, so that's a little update on the performance. What I'm looking at overall, and this is one of the things I want to cover in this episode, just to give a brief overview, I want to go over and give my thoughts on the overall economy, the markets looking over the next year. I'm not somebody that does a lot of projections into the future, but I do think there's some important things to look at. So I'll give you my thoughts on the markets overall, and then I'm going to go through some of these questions. I started a new channel called Questions for Joe, and it's pretty simple. If you have something that you want me to discuss, or like thoughts on a subject or an article, anything really, just post it here. I'll browse through it, and then I'll look at different topics I want to discuss here. So I'll go through and answer some of them. But I'll go through both of those. First of all, let's start off with my thoughts overall on the story fund, on the passive income account, on the markets overall. We have seen a lot of these type of companies, Netflix, Spotify, Facebook, Peloton, Microsoft, Salesforce, Square, CrowdStrike. DocuSign. All these companies, you can take pretty much any of them, and they have gone up so much in value in 1 year. It's been incredible to see. They've gone up from multiples of like trading at 22 PE ratios to 80 PE ratios. I mean, they've increased 2 or 3 times in market cap. Some companies like Tesla have gone up like 8 to 10 times the market cap. Even big companies like Apple have doubled in market cap. The PE ratio went from 15 to 30 in a matter of 1 year. So I look at that and I go, that's great if you bought these companies a year ago. That's really fantastic for the people that bought them, and they got to be part of that multiple expansion. But a lot of this expansion has not been from these companies increasing their earnings by double. It's not them earning twice as much as they used to. A lot of this is just multiple expansion, which means the company has stayed relatively the same, but now it's worth twice as much. There's specific reasons that make investors want to value them at a higher multiple than they did previously, and that's what I've seen happen with a lot of these companies. Now, I keep waiting for the day when investors will get sick of these stocks. When investors say, hey, these are at such high multiples, maybe we should shift over to value, shift over to something else, recovery plays. That doesn't really seem to be happening. When I look at their performance, I compare it week by week. If I go here, the week performance is 3.85%. That's pretty good. 3.85% in 1 week. If I look at the month, 5.96%. That's pretty good. The performance continues to go well with these companies, despite on most metrics them being overvalued. So as of right now, I plan on holding these stocks, and I just plan on continuing to invest, kind of ignoring the valuation of it. But I do have concerns overall with the stock market stretching the valuation of a lot of these companies. So that's just kind of a warning. Now, another thing I'm looking at here is articles like this. Morningstar has featured this on their homepage for about a month now. They came out with it November 3rd, and it's been featured on their homepage the entire time. We still expect a strong U.S. economic recovery. Morningstar is a really well-managed, well-run research firm, and they have a very strong argument of why they think the economy is going to recover in 2021. And they say the coronavirus third wave will not derail it. Neither will the lack of a stimulus. So they think that this economic recovery is going to happen regardless of any kind of external events. Even if we don't get a stimulus from Congress, even if we don't get a reduction in the cases of coronavirus, they still expect the U.S. economy to recover. Now, if we do get those things, if the vaccine works really well and the cases go down, or if we get additional economic stimulus, they think the recovery will be extremely strong. It'll be faster paced than normal. Now, let's go ahead and look at some of their arguments. They say 2 main threats have emerged to our optimistic thesis. First, investors are worried that additional stimulus won't be forthcoming or that the November election outcome could have other negative consequences. However, we think the recovery should be in good shape even without additional stimulus. That line right there. Even if we don't get additional stimulus, Morningstar still thinks the economy is going to recover. Vaccines are far more important to our economic view, and we remain optimistic that a successful vaccine will be deployed in the first half of 2021 and allow for a largely complete return to normal. They think the vaccines are going to work. I think the same thing. Why would the vaccines not work? We have 3 that are over 90% effective. They're supposed to be safe. I think that's the biggest challenge right now, is you get headline news like this. You know, there's elderly people taking the first vaccines right now. This is the big news. This is why they credit the markets going up right now. But a lot of people are skeptic of the vaccines, I think reasonably so. Anytime you're injecting something into your body, you want to make sure it's going to be safe. You want to make sure it's going to be a thing that doesn't cause some weird side effect long term. So a lot of people are saying, well, I want to see the first rounds go out and see how those people do, right? I want some other people to be the guinea pigs. I think that's going to happen. There's some people that are not concerned about the vaccine. I think that there's some people that are concerned about the vaccine, but they're much more concerned about the coronavirus. I had the coronavirus like a month ago now. Yeah, about a month ago, maybe about 3 weeks ago. And I'm healthy, so it wasn't a big deal. I got through it just fine. I had 2 days of feeling really fatigued, but then I lost my smell completely. I could not smell anything for like 2 weeks. And I mean, I could stick my nose in apple cider or, Parmesan cheese or things that I normally have a really strong scent, and I couldn't smell them at all. I could taste just fine. In fact, my taste didn't seem to change at all. I don't know what does that with the coronavirus, but I'll say it's very unsettling. That right there, if I could go back in time and decide between getting the vaccine and getting the coronavirus, that right there might have changed my opinion. Where I would have been skeptical of the coronavirus or I would have been skeptical of the vaccine, and I would say, I want to kind of avoid that and just risk getting the coronavirus. After losing my sense of smell completely and then wondering, am I ever going to get it back? I might say, I'm going to risk it with the vaccine and take that. So I think a lot of people are weighing both options right now. And I think a lot of people will choose the vaccine because they see some crazy things happening with the coronavirus, even with young, healthy people. But my experience with losing smell was kind of frightening. I've since gotten some of it back, but not all of it. I can at least now smell some things a little bit more muted than I could before. But regardless, we have this news going on right now with the vaccines being rolled out. There's people taking them. This is real. They're expected to be very effective. And my assumption is that out of the many companies making vaccines right now, there will be one that is both safe and effective. We could have as many as up to like 7 different options. So if one of them causes issues, we could at least look at the other ones and say, hey, let's stop taking this one. Let's start taking the one that doesn't cause issues. So my thoughts are, out of the many vaccine options that we have, one of them is going to be successful. And I think if it's like any other vaccine, it should ultimately cause enough immunity to get rid of the coronavirus. So this is part of their thesis, is that in 2021, we're going to see a reduction, a complete diminishing of the coronavirus throughout the US and Europe. And that would be incredible. Imagine what stocks would do well if the coronavirus vanished overnight. That's kind of the scenario you need to look at, is what companies would be doing well right now if the coronavirus just vanished, because that could be the case in like 7 or 8 months. They say other main threat is the coronavirus third wave, but we think the economic activity should hold up fine as it did under the second wave. We see the same thing happening right now. We have record cases of the coronavirus. We had one day where we logged 227,000 new cases, over 2,000 people dying a day from it, and we had jobs gains. There was more people going back to work than becoming unemployed. So if we're in an economy where when people can still find employment, when we have the coronavirus spreading over 200,000 cases a day, that is a resilient economy. The coronavirus is not as big of a threat to the economy as it was prior. And I know a lot of people try to say we need additional stimulus and politics. It goes into play there. We don't even need it. The stimulus that we gave out in 2020 was the biggest non-war stimulus that our country has ever done by a mile. It was the biggest stimulus ever. We give out trillions of dollars in stimulus. So we've already given out a lot of money, and I think that will help over the long term. Additional stimulus won't hurt, but the economy is in pretty good shape. They say the consensus has moved about in line with our optimistic view. So here's their view, the dark pink solid line here, and here's the old consensus view. They say the consensus has actually shifted up above their view. So their view is actually the blue line here. The new consensus is this red line, and the old consensus was this red line dotted. So basically, now economists are looking at this and saying, wow, the economy is going to recover quicker than we thought. That's what they're saying right now. And Morningstar is saying, we agree with that. We think it's going to be a strong recovery. Moving on, they say we expect US GDP growth of negative 3.4% in 2020, about 550 basis points below our pre-COVID-19 expectation. This drop in GDP is much more severe than the Great Recession in 2009. So we have a drop in GDP this year that goes under 2009. Not good, because 2009 was really bad. But they say, nevertheless, we expect strong catch-up growth in 2021 and the following years, such that the US GDP recovers to less than 1% below our pre-COVID-19 expectations. That's a much better result than the Great Recession, which caused the lasting drag on the US economy. So they think that, yes, this year is going to be tough, but the catch-up next year is going to more than make up for it. And you can see that right here with this graph. We look at the GDP growth over time. The US is a very mature economy, so having 2.4% growth is pretty good. If you looked at it with companies, the US would be like a big blue chip company that's already massive, and it's growing at a pretty slow rate. Now we have a year where we have negative growth, the economy contracted, we're in a recession, but here's the V-shaped recovery. They think in 2021, we will have 4.7% GDP growth. That is a huge rebound. That's not just going back to the 2% prior and losing out on the GDP in between. This would kind of make up for that loss there. So this is all very good news about the economy. This is something I've been very optimistic about for a while. It's why I've been investing in companies that kind of rely on the economy more than companies that benefit from the destruction of the economy, because I think the economy will eventually rebound very quickly. And that's guided some of the investments into banks, like into resorts, into Disney, all these kind of companies that are right now in trouble. But the main point I'm making is when we have articles like this, the main point is that the economy is going to recover, the vaccines will likely be successful, and companies like these have benefited from the pandemic. These are the pandemic type of stocks. The tech stocks that have gone up to high multiples. Investors saw them as a safe haven where people can still do commerce while being shut-ins, while living in their house. And it stands to reason with me, this is just Occam's razor, it's basic logic, that if these companies benefit from having a pandemic, the lack of a pandemic means they're not going to benefit from that anymore. They're not going to benefit. It might not damage them to not have a pandemic around, but they don't have that extra boost. Investors aren't going to see them as the only viable investment option. And so with the economy rebounding and the valuation stretched of tech companies, I think there's a good chance in 2021 we could see the returns of tech companies kind of level out, not be quite as aggressive as they were prior. The stocks that have flown up like crazy, the Squares and PayPals and Shopifys and all these different companies that have just gone to the sky. They're still great companies. They're not going to be destroyed. The stocks aren't going to drop 50%. I don't think that will happen, but I think the returns will be pretty sluggish with them. And I think a lot of money will go into the value plays. I think a lot of money will go into these type of stocks. These type of companies like JP Morgan, Wynn Resorts, Disney, Store Capital, AT&T. I think the forgotten value stocks will kind of be the play of 2021. So I'm not suggesting that you go and you sell out of all your tech stocks. I don't plan on doing that. I plan on holding the tech stocks. I might be wrong. They could just keep racing up into 2021. I keep thinking that they're going to go down a value and they keep racing up. So that could happen for longer than expected. But what I see is a little bit bubbly. I think it's getting to the territory of being a little bit stretched valuations. So I would pick these type of companies a little bit carefully or invest in them kind of in an index, kind of do what I'm doing and just buy a bunch of them broadly because some of them are getting really high valuations. Now, that's my thoughts overall on the market. I'm very excited about value stocks. I think that those will do really well over the next year. I'm a little bit concerned about growth stocks in the short term. In the long term, I think they'll continue to do well. Now, one thing I wanted to do in this episode was go over a lot of the different questions that people asked. I started this Questions for Joe channel, and we had a lot of good questions here. So let's start going through these. The first one's from I Lost My Dog. He says, do you have a monetary goal? Your username's I Lost My Dog, and then the profile picture is a cat. I like that. Thanks for the good username. But you say, do you have a monetary goal to hit at a certain age in your life? I've not set any big set goals that I'm set on. I think by the time I'm 35, I'd like to have at least $500,000 in stocks just in my passive income portfolio. And I don't know how much in my in the story fund, but I'd like to have $500,000 in the passive income portfolio by 35. By 40, I'd like to be pretty set. I'd like to have over a 7-figure portfolio. That'll take a lot of aggressive funding. I'll have to buy good companies to help along the way. Even if we get close and not quite there, it'll be a success. But I think it would be cool by the time I'm 40 to be pretty set. Have my home paid off, have a 7-figure portfolio, and just be earning dividends and living life. That would be pretty good. Dividend Doggo says, how do you plan to educate your children on personal finance? That's a good question. I have 2 kids. One's a 5-year-old boy. The other is a 3-year-old girl. And they're just the best ever. They're who I spend all my time with my wife, other than doing YouTube. So they're a lot of fun. Educating kids on finance, I think the big thing is drawing a connection between work and providing value and then the results of it. Making it so they have a connection between work and value, I think is important. So I might go and when I'm shopping at Walmart or at Target or whatever, getting, groceries, my kid will ask for Hot Wheels. And I've actually kind of established the value of a Hot Wheel. I'll say one of them is $1. That can buy you 1 Hot Wheel. This toy over here is $4. So he knows that toy right there is the same value as 4 Hot Wheels. So it's 4 times as expensive. And then he's starting to make kind of a comparison. And since we're homeschooling him right now because of the pandemic, but we're homeschooling him and I've been teaching him math, And he's been making a connection with numbers. Now, if I'm like, that is $40, he'll be like, wow, that's a lot of money. He's starting to get this type of connection between the math and money. And then when I go to work, they don't understand what work is. They just think, oh, dad just leaves to work and then he returns home, later in the day. And so I started making a connection of that and saying, do you understand what work is? It's what affords all this stuff. So I go there so that we can buy this stuff. I go and try to produce value. I go and help serve other people to try to make money to be able to provide for you, with providing these toys and games and all this type of stuff we enjoy. So I think there's a fine line between educating your kid and not raising them too fast and causing stress or anything. I'm never going to do anything that will cause stress with my kids or make them too adult too quickly. But I do plan on educating them on at least the basics. When they get older and they become like teenagers and they want to learn about this stuff, I'm going to do the same stuff I do on my channel. I'm going to say, hey, if you invest in these companies, look, they pay you back every single quarter, every single month. You don't have to work for every single dime you make. This is a better route to do that. You can start buying equities, these businesses you have ownership of, and they pay you back money. And then this money you get, you can use to buy a gaming computer or whatever you want to do. You can buy, a new car with it or something, something that you enjoy. You don't have to work for all your money. And when you do that, I've done that with like cousins and even younger, like nieces and nephews that are kind of in their teenage year. And when I show them the power of investing, that you can get money back from it on a routine basis, that it's not just gambling, it's not just throwing money into a lottery, it's pretty amazing. Some of them are like, wait, how do you get money without working for it? You don't have to work for all your money? Oh my gosh, this is amazing. So they get really excited about it. They want to invest right away. And then all of a sudden it becomes like a passion for them. So I've have a couple nephews that actually like started portfolios, with under their parents' account. And it's pretty exciting. Now, let's go ahead and move on to the next one. Just a point of order. Okay, that's not really a question. Tell me your favorite holding and why is it IBM? It's definitely not IBM. I don't really know what IBM even does. I never see it at work. It's supposedly like an innovative company now. They're kind of transitioning. The last acquisition I think they did was Red Hat. I like Salesforce buying Slack so much more. IBM right now, it's not my stock. I'm never going to hold it unless I really see some real products that people are using that they can associate with IBM. I'd much rather put my money in Salesforce or Microsoft than IBM. Anyway, my favorite holding, I don't know. Right now, I wish I bought more Disney. That's a holding. If I could go back, I wish I bought more. I've been so tempted to buy more of that company. I just have such a good feeling about the streaming service. I think it's going to be such a huge success. And looking back like now, 5 years from now, and seeing if it goes up to like 200 million, 300 million subscribers and thinking, geez, I could have bought this company at $90 a share. I think you'll look at yourself and think you're so stupid. And I made videos about it, how good of an investment it was. And then I have money sitting on the sidelines. I could have bought more of it, but just the fear of having it be too big of a position and, all these different things kind of kept me doing a very moderate position in it. And then the stock races up to 155 or 150 in like 2 weeks, in a month. So now I'm like, well, I kind of missed this short-term window. Should I buy more right now? I don't think so, but Disney's probably my favorite company right now. It is the perfect combination of a traditional value stock that's successfully transitioned into a tech company with streaming. I think it will be a future dividend payer. It has a content library that's massive. They get such a good return on their investment. They've really only had one like great exclusive series, just The Mandalorian, and that's enough to drive 73 million subscribers. Imagine if they actually come out with multiple good exclusive series. They come out with some Marvel ones, more Star Wars ones, more just different ones from different universes. I think that Disney could be such a money generating machine. I just think it will be such a great company. So right now it's probably Disney. My holding size doesn't really represent that, but I have a hard time justifying, buying $20,000 of a company that doesn't pay a dividend when that's kind of the theme of the portfolio. So I have it in both accounts, but I should have bought more Disney a couple months back. If I get another opportunity, if it dips down, I will be taking advantage of it. Okay, let's move on to the next one. Dollar cost averaging or lump sum investing. I'd love you to do a video going over it. I have a good amount just sitting there getting no interest. Lump sum all the money you have now and then dollar cost in all your new money as you get it. That's the best option. Basically, every study that you can find, and these are like valid studies from Vanguard and Fidelity and all the good brokers, they basically say the more money you have in the market, the better. Just overall, if you put more money in the market, you're going to have a better result because the market does basically one thing. It goes up over time. You don't know exactly the pace it's going to go up or how long it will take for it to get past certain dips, but it does one thing. Over a long period of time, the future is that it's expected to have a good return. I think that will be the case going forward. So if you have money sitting in your bank account, the banks know that the future expected return of equities is positive. They're going to take your money. They're going to invest it into either different investments that they have, or they're going to loan it out. Either way, they're earning a better interest rate than you are. So your banks are using your money just to make money with it. If you put that money in the market, you'll probably have more money in 10 years from now. So my advice would be put as much money in the market today as you can comfortably, and then keep aggressively dollar cost averaging in. If you want to play it super safe and sit on a pile of savings, that'll bring you comfort. It's not going to bring you riches. You're just not going to make money leaving it in a savings account. That's kind of, I have my dad as I use an example of a real estate investor. He did really good using his money and kind of leveraging it. And, he used the bank's money to buy all these real estate holdings, I guess you call them, rental properties. But for his money that he had just on his broker, he bought CDs with it. He bought like 3 or 4% interest CDs. And he kept those CDs, which I think were like almost $200,000 worth, $200,000 or $300,000. He had them for like 20 or 30 years earning 4%. $300,000, 20 or 30 years. If he would have just put that in the S&P 500, that right there would be millions of dollars right now that he'd have. He'd have so much more money, it wouldn't even be close. So even if you're earning 4%, you're going to earn way more in the market over 20 to 30 years. If you're sitting in an Ally savings account earning 0.6, you're literally earning nothing. I have a lot of money in savings right now, but I've been pushing more of it into my portfolio aggressively because I'm like, what do I need this much money in savings? I just should put it to work. So I'm starting to do that and kind of speed up my deposit schedule. I've been doing that for the past few months. My advice is put as much money in the market as you can comfortably, as quick as possible, and then dollar cost averages as much as you can. Don't jeopardize your personal financial situation. Okay, Vagabond says, when you say valuation for tech companies have gone to stretched levels, are you thinking this will subside post-COVID or that the current levels will stagnate? Or won't the creme de la creme companies be overvalued and expensive? This is exactly what I was talking about starting this off. I just think these companies, they were everything in 2020. Nobody wanted to put money into anything else. And then in just the past couple months with the news of a vaccine, you saw these value stocks outperform tech for the first time in like a few years. They went up 30, 40% in just a month. And tech stocks have been kind of leveling out a little bit. They've been going up, but just eking out gains. They haven't been going double or triple. I think we're going to see more of that. Right now, there's a lot of demand for good companies. So I do not see tech companies selling off. I don't see a big crash with tech companies. What I do see is more options. Right now, like in 2020, we had a lot of demand for stocks, but very small supply. The only supply that was viable were these high growth tech stocks because they're the only ones that were actually making money in 2020. In 2021, we might see all these companies recover and investors will say, well, now we have the same amount of demand, but we have a lot more supply. There's a lot other companies to put your investments in. So I don't really see these companies like contracting down in multiples like 50% of where they were. Maybe some of them will cool down a bit. We have companies like Zoom that reported fantastic earnings and went down 15%. So some of them have really gone up. And I think that those ones are going to see slight contractions in multiples. I think they're going to come down a little bit. But I think overall tech will continue to lead the future. That's where everything goes, is technology. So I wouldn't say sell out of these companies. I just think the future expected return of technology companies right now is a little bit diminished. They've just gone up too much, too fast to have such a good future expected return. And meanwhile, I think there's better opportunities with value stocks, at least for the next year until the coast is clear. The vaccines are already distributed. The coronavirus is gone. The economy's reopening. Once all that happens, all the deals are gone. If you wait until the economy's reopened and everything's good and coronavirus is gone, you're not going to find any deals with value stocks. It's back to buying them with their 1 to 2% yields at very expensive prices. So right now I'm trying to seize the moment, put some money in the market. I'm upping my investments and trying to find what I still see some slight value in. That's why I'm buying companies like JP Morgan. I just see that they're not crazy overvalued yet, and I think in a year they might be. We have Strike saying, Joseph, what is your thoughts on FCFS? I don't know what ticker symbol that is. I'll have to look up that stock. I didn't read through these beforehand. Maybe I'll do that next time. Bundish says, Joseph, what do you think about holding Netflix? I feel like selling my shares. There's a lot of competition in the space from Disney and HBO. It seems like the only move is to either raise prices or produce expensive original content. They also lost the rights to some of their most watched content like The Office. Do you think that their growth will slow down? Not much. I don't think their growth will slow down much. I think that Netflix is another company that's you're paying a premium for. People don't understand the dynamics with competitive advantage of Netflix. They have such a lead already that when you have 200 million subscribers, they can invest so much money into content, and they split that up between all the subscribers. So every original they make, they can show to all 200 subscribers and not pay any licensing fee on it. They make it once, which is a fixed cost, and then they provide value to everyone. That is an incredibly good business model. The licensed content like The Office is more expensive for them. So I have concerns. I think that Netflix stays in the same category of it's going to have maybe a mediocre year next year. I can see not a lot of money piling into Netflix. I don't see any specific catalysts of it. It's true that they have a lot of competition, but in my opinion, who's going to cancel their Netflix membership? You might hear anecdotally a few people here or there. The numbers do not show the story of mass cancellations on Netflix. Every time I check the number, every quarter, they are making millions of new subscribers. The US is pretty saturated. So the US might ebb and flow up and down, but outside the US, they're still making massive growth. And the people that do like Netflix are willing to just keep paying more and more for it as long as they're producing more content. There's not many people like Netflix or not many companies like Netflix that can spend the budget that they can on a single library that's one subscription. You pay $150 a year for Netflix, and that gives you comedy specials, documentaries, blockbuster films, films that they have main big star actors in and actresses in every month. It's just a huge library of content, and they continually grow it. So I just can't see a lot of people canceling Netflix. I think the valuation of it, again, it might be in that basket of stocks that don't really have a huge catalyst over the next year. I'm going to hold on to it though, because I feel like if I sell out of Netflix, it's going to keep going up in subscribers. I think that someday we'll see Netflix hit 350 million plus subscribers. I really think that's going to happen, and investors will pay a premium. For new entries into the streaming war, they have such a hard time getting in. They either have to be Apple or Amazon to have big amounts of money to invest in content, and then they invest billions of dollars into content, and they have nobody to share it with. Apple literally is giving away their streaming service for free, and still people aren't watching it as much. So they can't buy their way for free into the competition that Netflix has. AT&T, they have this new news where they're putting movies on it, but look at the growth of HBO Max. It's been incredibly underwhelming. The only other company that has done good in the streaming war is Disney. That's the only other one, and obviously I'm hugely bullish on Disney. So there's Netflix in my mind, and there's Disney. The one outside of that I think is in third place is Amazon. With Amazon Video, it's hard to tell the value proposition of Amazon because they bundle it with so many things. So I'm not worried about Netflix. I think the company will do really well. If you want to look for higher growth opportunities, I think over the next year there will be companies that grow more. But I look at it as just a blue chip tech company right now. Netflix is as stable to me as Facebook, Microsoft, Apple. I think the company is as blue chip of a stock as it gets. Okay, Dresden says, why do you think Warren Buffett continues to bet big on Bank of America when JP Morgan seems to be the stronger investment? This is Warren Buffett. So betting against Warren Buffett, I don't feel like I'm betting against him, first of all. Investing in JP Morgan instead of Bank of America is not like, oh, I'm going against Warren Buffett. He's betting on financial institutes, which first of all is a good thing. If you're betting on JP Morgan, that is probably going to do well if Bank of America does well. They're kind of like the two best big four banks, in my opinion. Now, I think the reason that he loves Bank of America, I don't really know exactly why, but I know he likes the CEO. I've heard that they've had like personal conversations. Warren Buffett has made a lot of money with Bank of America in the past. He's had these special shares that he bought at rock bottom prices, and they appreciated really well. He thinks it's a really well-ran bank, and he thinks that it's undervalued. Warren Buffett is a value investor. He's not so much a story investor. He's not like Peter Lynch. He invests in value. He looks over the book of it. He looks over the valuation. With bank investments, it's very much like you're buying their balance sheet. You're looking at their loans. You're looking at the amount of income they're expected to make, the spread between them. You're looking at their risk associated with it. That's what Warren Buffett is wanting, is he's wanting the valuation. I'm sure that the team at Berkshire is looking at this and saying, Bank of America is clearly trading at a closer, like price to book ratio, right? They're looking at these different metrics and they're saying Bank of America is a cheaper bank than JP Morgan. So we have a greater margin of security with it. We have more protection and more potential upside once the economy returns to normal. I'm looking at it and I'm going, I know that Bank of America is a cheaper bank if you look at the numbers. It is a less expensive bank. I think the reason it's cheaper is justified. I think that JP Morgan is a better bank than Bank of America. I think it's a better bank. I think it's better ran. I think that it has a better future, and I think that it deserves to be more expensive. So I don't think that Bank of America is selling at a discount. I think it's selling for cheaper because it's not as good of a bank. That's my opinion on it. I look at the two banks and the technology between the two. I know that Bank of America has been focusing on their technology. They have an app that they've done a lot of work on. I think it runs really well. But I think some of the online properties of JP Morgan are much better than Bank of America. I think they invest more in their technology team. They do more acquisitions of fintech companies. I think that they're kind of ran more aware of what their competitors are doing. When you look at the competition with Square and those payment processors, JP Morgan is the only one that's announced that they're going to compete with Square. That is something that Bank of America hasn't done. They haven't come out with those card readers and said, we're going to compete directly. JP Morgan's building out this whole like it's pretty much a Square knockoff. They're building out a whole ecosystem for small businesses to be able to accept transactions, have that debited to their business account, do recurring payments, do inventory. They're doing everything that Square's doing like a fintech company, plus they're also a well-ran big bank. So they're like a smaller fintech company like Square, plus a big bank like Bank of America. When you buy JP Morgan, I think you're getting both of it. If you look at the market cap of Square, these companies are trading at like $100 billion. So if JP Morgan can encompass what Square's doing and Square has that valuation, I think that plays a role. So I look at the two banks. I like JP Morgan better because I think it's a better ran bank. Warren Buffett, I think, likes Bank of America simply because of the numbers. It's trading at a better valuation. Plus, he probably likes the CEO. I think that he likes the guy running it. So there's a level of trust and he has good numbers behind it. What one will do better over the next 5 years? I don't know. Who knows? But I feel fine putting my money in JP Morgan. Dave N says, how do you determine the following? What percentage of your portfolio should go to a specific sector? What percentage of sector should go to which company? Is it a formula? Strong financials, best story, growth prospects, dividend or capital appreciation. I used to do this much more on I want to have a balanced portfolio with kind of a good weighting on every sector. I've moved away from that. I don't balance the portfolio by wanting to have all the exposure to specific sectors per se. And I think that the sectors are kind of I have one that's like 40 grand in tech, but what is tech? I have Visa and MasterCard in it. I have Microsoft, I have Apple in it. Those are completely different companies that do completely different things, but they're kind of in one sector of the economy. I think it's kind of a misnomer, kind of a sham, the way we label things in sectors. I think a lot of it doesn't make sense. So I wouldn't pay too much attention to the sector weighting of my portfolio. To me, it's more of a folder to organize stuff, just for the sake of user interface experience. I have these companies here, I have these ones here. It's not really a sector weighting per se. If I wanted to look at that, I would have to really categorize the companies and what I think their risk is, what I think their category is. So if I went through, and I might do this in the future, I would categorize companies to where I think the same type of events would affect that company and the same type of competitors would affect that company. Apple might fit in more with like a different company than a tech one. Visa and MasterCard are those tech companies. They acquire a lot of fintech companies, or are they financial companies like banks? Well, a lot of people say they're financial companies. I don't really think they are because they aren't lending out money. So they're not at the same risk that banks are. And if the economy crashes, they might go down a little bit, but they're not going to be leveraged like a bank is. So it's hard to categorize these companies, but I would not pay attention to the sector weighting of my portfolio. I would look at just the holdings list and the companies that I have top to bottom. What percentage of sectors should go to the company? Lately, I've been investing in companies that I think offer the best risk reward, and I try to size the investment in that company appropriate to mitigate specific risk. So specific risk is risk that's like with a specific company. So if you have JP Morgan, that company has specific risks. It has the risk of committing fraud and getting caught doing it and getting a big fine. It has the risk of a black swan event causing a global crash and them spending a lot of money on loan losses. It has a risk of bad management and bad decisions. Those are all specific risks with JP Morgan or any company. Costco has them, Home Depot has them. All these companies have specific risks. I try to size the bet appropriate to how likely I think this company will have a risk like that. But most of the time, it's just I'm looking through these companies. I'm trying to weigh the ones that still offer good value, that I think I'll get a good return, that I think I have a high likelihood of making capital appreciation plus dividends in the future. If there's a company that I think will have a good next 2 years, 3 years in the future, it'll grow in capital appreciation, it'll continue to raise its dividends, it has something to offer in the future, and it has a good moat, and it offers a good risk reward, there's not a huge chance of it dropping 50%. Those are the ones I'm looking at. I'm also looking at something that's not mentioned here, which is specific bets I'm making now are ones that I know about the company. I'm not investing money in companies that seem like great companies, but I really don't understand them. There's some that I'd like to invest in, but I just can't bring myself to. Main is one of them, ticker symbol MAIN. That's a cool company that pays like big dividends. I think it pays either quarterly or monthly, but it pays huge dividends. It's a high yield company. They make a lot of money. It's done really well. I can't invest in it. I don't know how they make money, really. I don't understand the business model. So the companies I'm investing in are ones that I really feel like I've done the research. I know about the company, the leadership, the risks associated with it, how they make money, what the future looks like with their involvement. If I can't answer all those questions, if somebody asks me about a company and I really can't even describe what they do in depth, then I probably shouldn't be committing a bunch of capital to it. So companies like Main or NRZ, ones that I should really have never been in the beginning, I'm not going to invest in them anymore. I'd rather put my money into like Home Depot, JP Morgan, Store Capital, ones that I've done research. I really know them. If I need more companies to invest in, I'll just do more research. If I can't find anything to put my money in, I'm not going to venture into unknowns. I'll just put it in an ETF and wait till I find a good opportunity. That's what I did with a couple companies. I put it in an ETF, waited till I found a good opportunity with a company, and I took some of the money back out of that ETF. So that's kind of what I'm doing right now. Don't pay attention too much to the sectors. They don't really mean much, in my opinion. They're just a way to organize your portfolio. It gives you a very rough idea of the allocation you have, but it's not great. I don't think you should pay attention to it. Do you do valuation on your stock research? This is probably my biggest criticism, is that I focus on the story of a stock, but I don't look at any of the numbers, right? I just focus on the story. And if the company looks like it has a bright future with the story and description of the company, I just pour money in it. I don't think that's accurate. I look at the numbers with companies. I don't have like an elaborate spreadsheet where I do, dividend discount model or DCF or anything like that. There's some websites where you can do those type of estimations. That's available to everybody to do those type of valuations. Morningstar does all the type of, discounted cash flow and dividend discount, all that type of stuff. They have that baked into their research. And I reference that and see where they think the valuation of these stocks are. So I look at a lot of well-researched financial institutions to get an idea, like a starting point of investment. But I don't completely skip over numbers. When I'm looking at companies like JP Morgan, I know the market cap of the company. I know the PE ratio. I know how much net income they're making and how much they're expected to make next year. That's a huge part of my investment. I wouldn't put any money in it if I didn't know all those things. So when I'm looking at companies like that, I look at all those numbers. The reason I put $20,000 into Apple was I looked at every company around it, not just a couple. Every one of them was trading at a higher PE ratio. Apple was at like a 20 when I bought it, maybe a 25. And Facebook was at like a 30 something. Microsoft was at a 30 something. Amazon was at an 80. Netflix is at like an 80 or 90. Even Costco is at a 40 PE ratio. Nike's at like an 80 PE ratio. Here's Apple, probably the best company in the world, trading at like a 25 PE ratio. That's relative valuation. I'm not doing the intrinsic value of the company, but I'm looking at it and saying this is way undervalued when you look at it compared to anything else in the market. And this is like one of the best companies, probably the best company in the world. So I felt fine putting $20,000 into it, selling off all my bonds and going, I'm going to throw it in Apple. The valuation's so much lower than every other company that if things do pull back like crazy, Apple will be one of the ones I think will fall the least. So that turned out to be a good move. It made a lot of money quickly as it rode up to meet the same type of valuations that all these other companies did. And I think that was deserved. So I didn't sell my money out of it afterwards. But yes, I do valuation on stocks. The biggest things I look at is the current market cap, how much revenue it's making in comparison to its market cap. So some companies I think that might be overvalued are like Shopify. That has a market cap of over $100 billion, like $120 billion, but it revenue is like $1 to $2 billion. That's expensive. They need to double their revenue over and over again to justify that. So that's revenue compared to market cap. You compare that to the industry average or the type of company it is. That's how you can look at valuation. Another thing you can look at is the PE ratio, the multiple that it's trading at. Compare it to similar companies in the industry. See why it's trading at a heightened valuation or a lower one. Some companies deserve the extra multiple. Costco's trading at like a 40 PE. I think that that's probably overvalued, but it's a really good company, so it's hard for me to sell it. So I look at valuation. I look at the numbers of the company. I look to see if it's profitable. When I did my investment in Win, for instance, I looked at the recent income of the company. I looked at the stock price of it. I looked at the revenue compared to the market cap. It revenues a lot compared to its market cap. It was profitable every single year prior to 2020. So this is an outlier year for Wynn Resorts. Then I looked at the cash balance. Even if they continue burning money with literally no revenue, none. If they have no revenue all through 2021, they can live off of their cash balance all through 2021. So I just looked at all these factors and I thought this is a well-positioned company to make a bit of a rebound if the economy does recover. If it doesn't recover all through 2021, and then we go into 2022 with no recovery, they're going to have to go back and issue more shares and raise capital. They're going to have to like really shut things down to cut expenses. They'll have a tough situation. I think that's unlikely. So I feel like I don't include like the number valuation portion. I probably could do that more in videos. Maybe I should. But I do look at a lot of different metrics. I kind of do valuation compared to what the market's doing right now and what I think the companies are worth. But yeah, that's a whole different part. A lot of it, I would say the majority is probably story driven though. I like looking at the story of companies, seeing the leadership and the direction, the future, all that type of stuff. Mr. 920 says, Joseph, please evaluate the current pricing of BTZ. Do you think it is a buy or sell or what? Would you go heavy on fixed income fund if it had a reasonable payout ratio compared to that of other equities? I'll probably keep asking. Sorry if I ignore you, if I don't respond to something. It's not me trying to ghost you, I promise you. I get like 500 messages a day. Seriously, so many through email, text message, Discord, that, YouTube comments that I'm trying to check. And there's just a lot of messages coming in at once. And sometimes I'll check one and then I'll try to respond to it. But if I don't respond to it right when I get it, I'll either try to mark it as unread. So I'll be reminded to check on it later. But sometimes messages get lost in the mix and I don't respond to them. If that happens, just bump it up again. Just reply again and say, hey, you bump this question or something. And that way I'll see it again, because I'm not trying to ghost you. I respond to every single message that I get, but sometimes like a lot of them actually get lost in the cracks. So keep asking. That's good. And as far as BTZ, I don't know what that is. I haven't done research on it. I can't give you an informed opinion on it. A reasonable payout compared to that of equities. I think fixed income funds are fine. I don't plan on investing in them. I mean, it depends on a lot of factors, your age, your profile, what you want your portfolio to consist of. Right now, I feel really strongly about equities. I just think companies are mostly the thing to own. I think they're the best investment typically right now. If you're investing in fixed income, interest rates are low, yields hard to come by. A lot of them, they're not like inflation adjusted. Companies can do things to try to offset the effects of inflation. So yeah, I just think that equities are what I'm mostly focused on right now. Dassier? I don't know. I'm going to screw that one up. At what age do you plan to retire? How much would you roughly? And what made you come up with this number? And how do you invest around that to reach your goal? Like I said before, I have not picked out like a specific, I need X amount of money to retire. I know that's big for a lot of people in the financial independence community. They like pick out a number, like I can live off with a 4% or 3% withdraw. I can live off X amount based off of this type of return. I haven't done that. I'm just trying to grow wealth as quickly as possible. So we'll see what happens, but my goal right now is to grow my portfolio and the quality companies that will pay me out for a long period of time and try to balance risk and reward as intelligently as possible. I'd like to, by the time I'm 40, in 9 years, I'd like to be pretty set financially. And by that, I mean over a 7-figure portfolio and no debt. You might not be living in riches, but I'll be comfortable. You could just live off the dividends of a $1 million portfolio, especially if you have no debt, you have very low expenses. That's a great situation. And I don't expect to stop working when I'm 40. I'm not going to really retire, but I'm going to be financially just free, just independent. I'll have money. I'll have a portfolio that produces a lot of passive income. At that point, I'll probably get some money out of the portfolio or either get some dividends or leverage it a little bit to buy some rental properties. Like I'd like to be at the point when I'm 40 that I feel very secure financially, very financially independent, and I can start focusing my efforts on helping other people, not just online, but like around me in person financially, where I can start helping other people get into good situations. Because if I can help people get into like rental apartments or, into different investments, I think that'd be a good thing. Bogdan says, have you considered Flutter, FLTR, online betting from the biggest group, waiting to enter the US as they continue to regulate online gambling? I haven't gotten into online gambling at all. I know it's a big growing area. People love gambling. I think that's why we see so many traders and short-term people in the stock market. They're gambling. They just like it. I don't think there's anything wrong with it. If that's what you want to do with your money, that's fine. I want to have the best chance of making money as possible. I am invested in Wynn Resorts. That's traditional gambling. It's more of like an experience thing. So I think it's a little bit different. But I think that the future, let me put it this way. I think in the future, online gambling is going to be drastically bigger than it is today. Whether that's already priced in to the point that you'd consider, I don't know. I haven't looked at the multiples. Maybe it's already priced to grow 10 times and it's only going to grow 5 times the size it is today. So maybe it's already priced in. But I definitely think that online gambling is going to be drastically bigger in the future than it is today. People love gambling. People love the chance of making money without working for it. So anything that offers that in an easy, convenient way, it's going to be successful. What are your thoughts on NIO? When I first heard about NIO, my instant thought was, this one's going to be a winner. That was my first thought on it before the stock price went up, because I looked at it and I'm like, it's like a Chinese Tesla. It has all the right things. It's a Chinese stock, which already have kind of this like, oh, they're high growth stocks. They're in a market that can go like crazy. But it's also an EV stock. I stayed out of it because I'm doing the boring investing, focusing on dividend companies and stuff. So I stayed out of NIO. I could put it in the story fund, but I just haven't followed it all since then. So right now, I think it's past the phase of being speculative. I think the company's probably going to advance to be like a real thing. just my really uninformed, ignorant thoughts on NIO with very little research done on it, I think it will probably still continue to do well. There was so many opportunities for Tesla to do poorly based off of like issues they had and challenges they had, but they continue to do really well. NIO, I think, will try to just follow the same path, offer a good electric vehicle, and I think investors will continue to buy it. Jovan says, so Disney is at an all-time high, $154 right now. Is it still a good buy? I don't think it's a bad buy. I think you could buy Disney right now. You might drop down a little bit. You have to be okay with it dropping down 10% or 20% over like the next year or two. That's a possibility. You're buying it right after a huge jump up. But looking at it long term, do you think Disney Plus is going to continue to retain subscribers and grow its subscriber base overall? Do you think Disney Plus will get to the point where it'll catch up to Netflix? Do you think the parks will reopen within the next year, at least to more capacity? If those answers are yes, then Disney's probably still a good buy. It's hard to keep buying it as it goes up. That's something that's psychologically difficult. As I look at the price I could have bought it in, and now looking at it, I'm like, paying $50 more every share I buy, 33% more, it doesn't feel as good. But you can't look at that. You have to imagine if it hadn't run up, if it just stayed at 155 when they introduced their streaming service initially, the stock went all the way to like 150. You look at the graph of the 5 years of Disney, it went to like 150 just with them announcing the service. But then the company has blown away expectations by every metric with their streaming service, and it's still at 150 today. So if you look at that, it has 73 million subscribers, and it's still at the price of when they just announced their streaming service, when people didn't know how successful it was going to be. It was all speculative. Now we know, and it's trading at the same multiple. So yes, I still think it's a decent buy. I would just buy it knowing it's going to be like at least a 5-year holding. I think if you hold it for 5 years, I do think you'll make money on Disney. If you buy shares today and you ignore everything, you close your brokerage and wait 5 years, I think the share price will probably be way more. So that's my opinion on it. I've actually been contemplating recently just like continually putting more money into Disney. I don't think it's a bad company to invest in. Esports Noob says, what are your thoughts on international stocks for diversification in your passive income portfolio? Percent amount to have, what ETF perhaps would you suggest? With international stocks, I would not suggest an ETF, especially with China. I've looked at the ETFs with China. I don't like any of them. They're so volatile. They invest in so many things that you don't know what the companies are. I would pick out a couple companies like Alibaba, JD, Tencent. Those are the type of companies I'd invest in China. In Europe or like Canada or emerging markets, then I would probably pick an ETF. I haven't looked at them, but you could just pick a Vanguard international, like ex-US ETF, just get exposure to things outside of that. Personally, I feel no obligation to invest outside of the companies I know and the US economy. I don't feel any obligation to do so. I do invest outside of the US because I see companies that I want to own a piece of. That's the only thing that's going to get me to invest outside the US is companies like Spotify. I think it's just a great company. It's one of the few that can compete with US companies. It's ran by a guy that is like Daniel Ek. If you look at his history, just read about his history on Wikipedia. The guy was making $50,000 a month when he was in high school because of the websites that he was making. He's just excelled his whole life. And it's no surprise to me that Spotify is doing so good. It's ran by a genius. The guy's founder-led. He's running Spotify. He's accomplished a lot of things in his life. I think he's going to find creative ways to monetize Spotify, to grow it to bigger size. I'm just very impressed by his story, the leadership of it. And so it doesn't matter to me if a company's in the US or not. It all just depends on the company. I like Shopify as a product. It's Canadian. I'll buy it because I like the product. I like Spotify because I like the person running it. I like the product. Even though it's outside the US, I'll invest in it. I have a little bit of Alibaba because it seems like it has so many tailwinds. It's in such a good industry and such a growing place. So I just look at those specific companies. When I look at broad ETFs, all the like emerging market ones have not done well historically. And so I don't feel any urgency to put my money in them. When the US economy does terrible, usually the world doesn't do well. Emerging markets aren't going to do well if the US economy doesn't do well. And when the US economy does well, the returns in the US economy are better than the emerging markets. So there's just not much payoff in my mind in investing like outside the US unless you find companies that you like. But I would feel the same way if I was European. If I grew up in Europe, I would look for all the companies that I know about that I know they're going to be good investments. I'd invest in those first. I'd probably invest in like an ETF that I find that invests in all these good European companies. There's a lot of them. They make a lot of, they have renewable energy, they have car companies, they have some good tech companies. So there's a lot of investments I'd look for in your hometown first, and then look overseas in different places to try to buy different good companies. Okay, Freddie says, are there any semiconductor plays that you've been looking to make? I don't know much about semiconductor companies. I don't know much about the industry, about how they project sales and their sales funnel and their contracts. I don't know much about the lifeline of one like one chip. I just don't know that much about the industry. On top of that, I'm not too interested in it. Like, it's more, there's different things. I'm on the development side where I focus a lot on software, a lot on services. I'm not so much into like the IT technology side of things. So that's not my emphasis or my competency, I'd say. There's some people that really know in depth which ones are doing really well. There's somebody at my work that's more on the IT side of things, and he has very strong opinions on like chip makers and which ones are going to be successful for XYZ reasons, and he's done research on it. I just haven't put the time or attention into it, and I don't think it's too interesting. There's some companies I might look at. There's some big dividend payers in the semiconductors. I think that they're very necessary companies. They're going to be around for a long time. If I purchase them, I'd probably just buy some like concentrated ETF that got me exposure to a bunch of them. So no, I'm not looking to make any semiconductor plays right now. Next up, we have Cochin. He says, will you buy DoorDash or Airbnb IPO? Why or why not? Also puts on CrowdStrike. That's a jab at Freddie. Freddie right here is one of the biggest fans of CrowdStrike. So he really likes that company. I like CrowdStrike as well. I'm long CrowdStrike. I'm certainly not going to buy puts on it. So nice jab there, Cochin. But am I going to buy DoorDash or Airbnb IPO? As of right now, I'm leaning towards not. I don't think I'm going to buy either of the IPOs. The companies seem good. I think they're going to be relevant. I think they'll continue to grow, but the pricing is a little scary. I think these IPOs are going for such crazy prices. And like I said, there's a lot of demand for tech companies right now. A lot of demand for these newer IPOs. They know that, so they're bidding up the initial public offerings a lot. If you look at Airbnb, I just read article after article of how expensive it is, and I'm sure it will even race up like the first day. That's usually what happens. It'll be a very volatile first couple of days with these companies. I do have some specific concerns with DoorDash. Airbnb, I just don't know enough about. I've never used it. I really haven't looked at the company that much. I don't know. I think it's an interesting company, but it's not like one that I'm super, I feel like I need to really research. The one that I should have stayed in was Snowflake. That was a company that I heard personally from a couple people that it was a fantastic product. They used it at the companies they worked for. I got scared out of it because of the price point, even though I knew it was a great company. So I sold out of that one, and then it's up like twice from, or even more than that from the IPO. So that's the one I should have hung on to. DoorDash is one. I've used the product, and I can't really decide whether I really love it or not. It seems like a good product. Sometimes it's convenient. Other times it's like, man, I just paid so much money for a meal I could have got for like half as much. By the time you factor in the extra prices they pay on just the normal items, so like restaurants will charge more, or DoorDash will charge more for the same item, and then on top of that you have to pay like a tip, and then on top of that you have a monthly subscription if you want free delivery. So you have all these fees attached to it, and I'll order some things that I'm like, I just spent like $37 on a meal for me and my wife. Just is a lot of money going towards food. So I can't decide whether I love DoorDash or not. Sometimes I'm really happy to have it when I really don't want to go out. It's like a long day. I don't want to go travel and pick something up. So that time it's nice, and other times, it just seems expensive. So right now I'm not buying either of them. I feel like I have a lot of really good companies in the story fund right now. When I looked through every company I had in the story fund and I thought, would I rather have DoorDash than this company? There's none of them that I said, yes, I'd rather own DoorDash than this company. All the ones that I have right now, I really think they have good stories with them. Like, I really like the situation of the company. I like their business model. I like the subscription income, the economics of it. And I just haven't been able to get rid of one. And I'm at the point with the story fund where I feel like I have a lot of companies. I don't need to really add anymore. I could add more and make them like 1%, but I just think I have enough right now. So I'm holding off on investing in these IPOs. I'll follow them though. I think they'll be interesting to see. So we'll see if these do really well or not. Gaurav, I think, says, what is your take on meat replacement stocks beyond meat, considering population growth and meat supply is going to struggle to keep up, and also the environmental factors associated with the meat industry? Yes, I've heard all the arguments. Meat causes a lot of the carbon emissions is from meat. It's not from like cars, because we have so much cattle and so much livestock that apparently it causes a lot of emissions. I don't know all the science behind it. I could see more fake meats coming to market. I think that there's a market for it. This is another one that doesn't excite me a whole lot. I don't see them as having a huge moat. How difficult is it to make a fake meat substitute? I think that's some relatively simple food engineering. The value that you're getting when you buy Beyond Meat is not like their special recipe. It's kind of the same thing with Coca-Cola. There's a lot of companies that can rip off the recipe from Coca-Cola and make a drink that tastes almost identical. So the value is not in their like special meat blend. I don't think it's going to be in that. The value is just in name recognition. It's in their market share. It's in the network effects of already having contracts with like fast food chains and stuff. So that's what you're buying when you buy Beyond Meat. Is you're buying their whole network that they've already established. You're not really buying their proprietary blend of meats, because I think that can be easily ripped off. And I haven't done a lot of like analysis to see how valuable that is with Beyond Meat. But I would look at the point of, if you think they've grown to the point where they can just kind of like outbid, outcontract every other competitor, and if you think Beyond Meat has some type of competitive advantage. So that's what I'd be looking at with Beyond Meat. Right now, I don't plan on initiating a position. It doesn't follow the type of stocks that I've been looking at. Strike says, thoughts on the new Roblox IPO and FCFS. I don't know FCFS. I know about Roblox. I've seen that game before. It's a silly game. I don't know. It's like buying a single game is an interesting thing. Would you buy Minecraft? Would you buy Fortnite? Just the game? I don't know if they're going to make like expansions to it or come out with other things. I don't plan on buying Roblox IPO, but I could actually see it doing well. Some of those games that are like building block games, they seem to stick around for a very long time. If I could, the type of gaming companies I would like to own Riot Games. That is a game company that I would like to own. They seem to know how to monetize games and build games that people want to play over and over again, and their games have a long lifetime. So they're just a really good company at doing that. I think there's some good game companies. That's one that I'd like to own. I know that Tencent, I think, owns all of it. So I'd have to invest in Tencent and hope that I get exposure that way. Love to Doc 69 says, we need to get JC's thoughts on ARK. That one has a lot of interest, a lot of thumbs up. That also may make the dividend community very mad. This whole thing where like, there's a group of investors, okay, that are earlier followers, because I came out with content of my dividend growth portfolio. That was the focus of the channel when I first started. And so there's a lot of initial investors that are like, okay, I followed you because you're investing in dividend companies. But anything I do that's outside of the approved dividend purchases in their mind is like some type of sin. Like I'm, straying from the flock of the dividend community. And I think that that's an attitude that should be avoided. You shouldn't have some type of cult-like attitude with dividend investing, and you have to bar out every other good opportunity or good thing because you're so principled that you never go outside of that. That's not what my attitude is. I like generating passive income. I like companies that have low payout ratios and help build up my income stream over time. But I'm not like some dividend purist, like some cultist with dividends where I'm going to go away from every other type of investment. So that there's a group of people in the community that they will be mad or upset if I buy anything other than like the dividend aristocrats or the dividend kings or contenders, the companies like Pepsi and J&J and Pfizer and Merck and AbbVie and the companies that have been paying dividends for 20 years. If I don't buy one of those companies, they will be upset. If I buy anything that's like any special circumstance, like my purchase of Disney, when they froze their dividend, they'll be upset by that. I don't think it's a big deal. I'm looking for companies that down the road are going to generate a lot of cash flow for me and build up my passive income. And that's the overall goal, but I'm going to look for opportunities in this specific situation. Now, my thoughts on ARK Invest are, I think Cathie Woods is a remarkable person. If you look at people that are able to do what she does, there's very few. She had incredibly good returns. She's been incredibly public the whole way, explaining her investments, explaining her philosophy. She's kept to what she's explained the entire way with a tremendous amount of backlash, a tremendous amount of public backlash the entire time. If you look at some of her earlier interviews, when she was saying, Tesla's the place to be. That's the stock you want to own is Tesla. And she put 10% of her fund's money in Tesla. Like, I don't know, like millions of dollars, hundreds of millions, maybe even billions of dollars at the time in Tesla. This was back a few years ago when Tesla was considered like this overhyped, joke of a stock. And the comments on the videos are like, this lady's so stupid. This is why women aren't in finance. There's like these sexist comments, these dumb comments of people saying how dumb she is. And I kind of feel for her in that situation because whenever your investments aren't doing well, but you know that they're good investments, people will come at you and look at your immediate performance and say, well, you obviously don't know what you're doing because you're down right now currently, right? She wasn't making great returns like 3 or 4 years ago, but here she is like the hottest money manager alive right now. She's like one of the most popular because of how successful she's been. And she's kind of spurred this whole movement into innovative investing. So my thoughts on Cathie Woods is she's completely remarkable. She's definitely launched her career into like the stratosphere right now. She has a lot of eyes on her and she has a lot of people looking at what she's doing. She's changed investing. She's created entire funds and she's actually moved investing to thematic investing. That's a whole new style of investing. Thematic investing, focusing on themes. And I do like focusing on themes. I think that that's a good way to invest is look at specific themes that you want to focus on with companies or different industries. And hers is like innovation. My thoughts on ARK are, Cathie Woods leading it, I think is a good thing. I like their investment philosophy. I think they have extremely good analysis that's like second level thinking. A lot of their analysis they do on some stocks is exaggerated. They really make their case. They're very public about it. They do a lot of marketing. It doesn't follow the same type of old school investment trends of being like more sophisticated. They try to just say they're investing in the most exciting industries, the most exciting companies, and the returns should follow. I do think that there's a lot of bandwagon of like effect with ARK Invest, where a lot of people are jumping in now when the prices of these companies have already ran up tremendously. And I don't believe she's going to be able to maintain this level of performance at all in the future. I think that her performance going forward is going to be, a little bit more tame than what it's been this year. The circumstances that would happen in 2020 are unlikely to repeat themselves, and those circumstances are undeniably good for ARK Invest. She's even said, like, in these type of situations, these companies do well. Again, we're going to come out of this situation. It's not normal. We don't really have pandemics all the time. So it'll be interesting to see how ARK Invest's performance is going forward. The true test with ARK Invest and Cathie Woods is this a once in a lifetime event? Is this a once in a lifetime performance? Or can she keep this going forward, like for the next decade? Can she do an annualized return of 20% plus for 10 years? That will make her one of the greats. But right now, she's not one of the greats. She's someone off to an incredible start. She's on a path where she can be one of the greats. She's not there yet. She does have a lot to prove to be one of the Peter Lynch's, kind of Warren Buffett type of people. She's not anywhere in that category. Time will tell. That's going to be 10 years of performance and how well she did over that time. Okay, Nike Cortez says, if you are an activist investor, which company would you like to see big changes? And if you also follow ESG, then which company would it be? If I was an activist investor, I haven't thought about this one before. That's a good question. I've not heard this one before. I would say like a company that I would like to take over and try to implement my changes would be one that I think is being severely mismanaged. And if you think of those type of companies, they're usually not the ones I invest in. Because if I invest in a company, I think most likely it's going to be really well managed. Like, I'm not going to be able to run JP Morgan better than Jamie Dimon. I would never try to be an activist investor and get on a board seat and say, you should be doing XYZ. He knows far better than me. So that's why I'm kind of hiring him to manage my investment of JP Morgan. And I think that should be the situation with most of your companies. I like the Warren Buffett approach of buying companies that really don't need a lot of handholding, more than the Bill Ackman approach of trying to bully your way on a company board and then changing things to create more value. I don't think there's anything wrong with activist investing, but I think it's a tough thing to do. Trying to think of companies that I would like to be an activist investor and create more value for the company. Maybe AT&T, that would be maybe one of them. I bet I could go in and just modernize some of their thought process with the way that they're making decisions for their company. But I feel like they've already made a huge leap in doing that. Releasing their movies simultaneously between theaters and HBO Max is a huge move in the right direction. And I like the way that they implemented it. The big question is, are they going to charge extra for the movies? It'll be a total loss, a total mistake if they do that. If they charge extra for the movies, like I reverse their thinking forward and their thinking for the future. I reverse that. They're still thinking temporary. They're still thinking immediate gains. I think AT&T needs to bump up their subscriber count dramatically, and they need to do it quick. They have an opportunity. They have a window. They have been wasting it all through 2020. This is when they should have millions and millions of gained subscribers, and this window is going to be gone soon with the pandemic. And so they need to bump that up. I would want to go into AT&T, say, put the movies on here, make a big campaign, get as many subscribers as possible, and then work on retention. If people get into HBO Max, I think that they might have high retention, but it's still difficult because it's one of the more expensive streaming services. Other than AT&T, right now I can't think of any company that I think I could manage better than the management of the company. Maybe there's some I'm not thinking of, but I try to focus on companies I think they already have great management teams. Next up, we have, I don't know if I can pronounce your name correctly, so I won't slaughter it for you. You say, hi, Joseph Carlson. I am newly investing and I see that most of your investments you already have gone up significantly. Would you recommend still investing in them, or would I wait for new picks? I'm always on the looking out for new picks. So that is the hunt. I'm always looking for new companies to invest in that offer a good value. Recently, they have all gone up like crazy. If I look at some of my top convictions that I've been talking about for like the past couple months on the channel, Store Capital is one of them. That one's gone up a lot. I still think it has some room to run. We have AbbVie. That one's gone up a lot. We have Disney. That one's at all-time highs. We have JP Morgan. That one's gone up like 25-30% in the past month. I think it obviously still has a lot of room to go over the next couple of years. So I think JP Morgan is one that still has value right now. That's one I would still buy. And then we have Wynn Resorts. I bought that one, and then like 2 weeks later, it was up 15 or 12 or 13%. So a lot of them have raced up. I would say out of those stocks, I still think Store Capital has value. I still think JP Morgan has value. Over the long term, I still think that Disney will do well. If you buy Disney, I still think over the next 5 years, it'll be worth more. But I would be a little bit more hesitant in pouring money into Wynn Resorts. I'd try to buy that one when it's under $100 a share. I think it offers a little bit more safety there. So I probably wouldn't be pouring in like your life savings into Wynn Resorts. I don't know. So JP Morgan, Disney, Store Capital, I still think offer value. Outside of that, I'm looking at different stocks. One that I'm looking at right now is Home Depot. That's one I want to jump in. It's trending down a little bit. If you look at the graph, it's gone down. The further Home Depot goes down in price, the more tempting it is for me to buy. Home Depot is as solid of a dividend-paying, long-term, huge moat. Just an indestructible company. It does well through a pandemic. It does well through booms and busts. It's just a great company. If that one comes down in price, I'm going to be pouring money into Home Depot. So that is on the watch list. If it keeps trending down, I'm going to start putting more and more money into it. Other than that, I'll let you guys know on the Your Trades and Joe's Trades channel which ones I'm buying. So those are the ones I think offer currently good risk reward. The next one's from SNL. He says, "This is not a question, but a suggestion. I would love to see podcasts with experts in the field, at least with our community. For example, a podcast with Koshin or real estate if he's interested, how he got started, stocks versus real estate, or a healthcare expert talking about the field in general and interesting opportunities available. You're bullish on Spotify moving to podcasts. Time to follow the lead." Yes, I need to get into that more. Part of it, I've done the one interview with the CEO of M1 Finance. That was pretty fun. It's kind of nerve-wracking. I don't think I did like a good job doing that because I was so focused on trying to not have dead air that I wasn't paying attention to what he was saying. So I kind of had like my responses ready for his response before he even said anything and I acknowledged it. So it was an okay interview, but I think I'll get better at that over time if I keep doing them. I think I want to do an interview with my dad because I feel like that would be of interest to the community. He has been highly successful in finances. He's somebody that like family and extended family often go to for financial advice. And he was a cop for his career. He worked in law enforcement for 33 years. He wasn't one that went out and patrolled. He worked in an office. So he has a degree in administration and he worked in an office. But, you know, it's a limited salary. You don't make a ton of money as a cop. And he turned that into millions of dollars worth of real estate, pretty much. So he would be somebody I think would be really good to get his perspective on it. Even though he's older now, he's retired and hasn't been like in the stock market game. He doesn't pay attention to this stuff. You know, he pays attention to what he wants to do. He pays attention to what he wants to do with his free time because he has all the free time in the world. So that would be one interview I want to do. If Kojin wants to do an interview, I'd be happy to do that. It could be an exclusive thing as well because I feel like outside of the Discord community, not many people really have a clue who he is, but inside the Discord community, he's one of the more known figures. So that's kind of up to different people. Not everybody is as comfortable being in front of a large audience as others. So I'll have to talk with different people and see. But yes, that is a good suggestion. I should do more interviews. The next one's from Coyote Soul. He says, "Do you have a routine or system you use in your day-to-day for researching stocks? I try to delve into it and quickly feel overwhelmed. I can only take tiny bits and it doesn't feel like it amounts to much in any way actionable information." You're overthinking it. That's what I think. I think some people, they get into all the tools because people want to make everything into a big, grand, like complicated mathematical equation where the most complex way of doing something leads to the best results. That is not what I've seen work with investing. A lot of times it is the most simple decisions and simple logic that leads to outperformance. Like what companies are just going to do the best over the next 10 years? What companies are going to be the biggest? What companies are going to have the most eyeballs on their products, the most people using their products, the most people transferring money through them or to them? You just look at where the trends are going. Look at what companies are being used and have real e-commerce and real commerce in general using these products and services. And those are probably going to be the winners. It's pretty simple. And then when you figure out what companies you want to buy within this big basket of companies you've identified as the future, companies that are going to be around for a long time, then you just figure out an easy way to price them compared to competitors, compared to the industry. What type of premium should you pay for them? Or if they're not like the best company, what type of discount is worth it to jump into them? You know, it doesn't have to be super complicated. So you're probably overwhelming yourself by thinking about it way too much. What I would do is I would start big, look at all the companies you think are going to be the most used over the next 10 years and gain the most attention from people. And then within those companies, try to look at pricing and opportunity. Whatever ones you think are being like missed by other investors, but will be realized later on, those are probably the best investments. In my routine, obviously I run this channel, so I'm spending a lot of time doing research and reading about financial news, even more than I used to do. Before starting YouTube, I read the Wall Street Journal every day, but now I read it like all the time. I read a bunch of financial journals, Market Watch, Wall Street Journal. I'll read Bloomberg, Financial Times, some New York Times stuff. They really don't have as much investing stuff. I read Seeking Alpha, get people's arguments on stocks, good or bad against them for ones I'm interested in. I use a lot of the financial, like, I get a lot of the numbers from Seeking Alpha. I like the way that it display the data. So that's the website I use. And then I just recently signed up for Morningstar. It's like a $200 subscription, but I figure they're a pretty good analysis firm. I don't base my buys and sells off of any one of these sources, but I use them all to get a collective, like a well-rounded view of a company. So a company that I'm interested in, I'll read Morningstar's entire research on it. I'll look at the current news. I'll look at different sources on it. I'll go to Seeking Alpha and read arguments against it and for it, and kind of just formulate my opinion based off of all the information available. And then I'll usually get your guys' opinions too and see what you think. And if anything, it challenges me to reassess the companies I've looked at. That's a huge cumbersome process I go through, but you have to know the companies I'm buying, other people see them. So I feel a higher burden to make sure my investments are good investments than even if I would like a private account. In a private account, I'd probably buy companies with a little bit less research. Like I wouldn't delve into them quite as deep. But now I feel like, man, I'm putting my investments out there. There's like 50, 60, sometimes 100,000 people watching it. And some of them are going to buy it because I bought it, and they got this new research. So I want to make sure I have empirical data. I have, different like credible research analysis done on it that also agree with my thoughts on it, that I transparently give my arguments. So if people don't agree with me, they can, disagree and not buy it. I try to make it as well-rounded as possible. So I don't feel like most people have that same like pressure when they're making buys and sells. But yeah, for research, I use Morningstar, Seeking Alpha, Yahoo Finance, Wall Street Journal, even like I'll look at different investing forums and stuff. And then this Discord, I get a lot of information from people that are good in particular, like industries or things. So between all that, I form an opinion on it. Next one's from Joven. He says, would you do a podcast with a fellow YouTuber, like a joint collab? I remember you plugged in Jeremy from Financial Education. I would be fine doing a podcast. I've talked about it before. I know Jeremy wants to do one. I don't feel any pressure to. My audience doesn't expect that. I'm not like a Joe Rogan interview a new person every week. And so I guess I just haven't done it because it takes a lot to set up. There's a lot of extra things outside of my normal process, and I'm already really stretched for time. So I can do that. Just hasn't been a huge priority. Biomechanica says, when making decisions in a stock, how big is the role of gut feeling on certain situations? You invest initially because of your brain, not your gut. You shouldn't be buying companies because you have a gut feeling that this company is going to do well. Peter Lynch famously says, you don't buy stocks because this sucker's going up. That's your reasoning for it. It's just going up. I just have a feeling it's going up. No, you have to have some reason. Lay out your argument of why it's going up. What catalysts are going to cause this stock to go up? You need to have logical reasons of why a stock will go up or down, why a company is going to be able to afford to pay a dividend, why it will have more customers in 5 years than it has now. You need to have logical reasons for that. The gut comes in, your stomach comes in, when you've already made all the logical decisions, and then the stock drops 20% and you now want to sell it because you're becoming fearful. And you meant, oh man, I'm second guessing myself. That's when the gut comes in. So I don't buy or sell based off gut feelings, but I try to ignore my gut and ignore my like this stock. I don't like seeing the red on the screen. That's an alerting thing to see, is when I have a stock in the red. I held AbbVie when it was in the red for a long time. My gut or my like instinct is just to want to get rid of any stock that's in the red. I just want it gone from my portfolio. I want everything to be beautiful green and to just go up indefinitely and never have dips. But I have to listen to my brain and say, well, AbbVie's in the red right now, but this is still a great investment. So instead of selling out of it right now, I should just hold on to it and it'll probably go back in the green because it's a great investment. So despite what other people think of it, right now it's a solid investment. Sure enough, like in a month or two, it goes back into the green. So the gut's important. You got to have a strong stomach when you've already bought a company. If I have a gut feeling that a stock is going to do well, that might further my research into it, but I don't buy it just because I have a gut feeling. Okay, Tom says, would you like to see Trevor Milton arrested or reprimanded for fraud? I would like to see Trevor Milton have an honest, good faith investigation into Nikola and him personally. That's all. I want to see a good faith, honest investigation that appropriately applies the law in that situation. I don't know what that is. I wouldn't really have like all the data with it. From my personal take on this, I think Nikola was an incredibly deceptive, fraudulent company that misled investors intentionally. I think that's a crime. I think that they should face harsh penalties and the possibility of like arrested or some type of real charge. I think that people like Trevor Milton, he's a hustler, right? He did everything he could to make this company go up in market cap. I don't think he cared so much about creating value. I don't think he cared about the investors. I think he cared about the market cap and it going up at any cost possible. And if that meant driving a truck up a hill and rolling it down and then filming it with the specific wording to be like a, the way that they did the wording was such legal nonsense to have a kind of alibi. Well, we didn't say it was driving. It's nonsense. It was intentionally deceptive. In my opinion, it was fraud. I think that it was a fraudulent act. I don't know how the law is applied in this situation, but I think that the law should be applied to him just how the law is written. What is the consequence of doing that in our legal world? And can they prove that he did that, or that Nikola did that? And I think that they should have the full law applied to them. So that's my opinion on it. Have you ever considered working at Trader Joe's? Nice one there, the film. Have you ever considered working at Trader Joe's? No, I've never considered that until right now. But after reading that comment, now I'm starting to consider working at Trader Joe's. If I worked at Trader Joe's, I wouldn't have to deal with comments like yours, okay? So maybe I should be working at Trader Joe's, but then I'm sure I'd be even more comments of Joe working at Trader Joe's. So on second thought, no, I don't plan on working at Trader Joe's because I'd probably be made fun of even more in that situation. But nice comment, laughy one there, okay. What percentage of the way, this is from Kez again, he says, what percentage of the way are you to financial freedom? It's a what do you call it? A spectrum, right? Financial freedom is not a pass-fail. It is a spectrum. You're all on a different degree of financial flexibility and financial freedom. I'm very comfortable right now. I live a very financially stress-free life. I have a lot of savings. I have money invested. I have multiple income streams. I have a good enough education and a network built out with workers and people around me in my community that if my YouTube completely went away, I would be totally fine. And if my standard work went away, I'd be fine with YouTube. So I'm in a very unique position where I'd consider myself very financially stable and I don't have much financial stress, but I'm certainly not like financial free, as in I can just go travel the world without worrying about income. If all my Discord members fled and they didn't, contribute to the Patreon, that would be a huge income loss. If I lost my other normal job, that would be a big income loss. If I lost my YouTube ad revenue, that would be a big income loss. And that would be not enough to survive on. I wouldn't be able to survive on my dividends right now. So I'm getting there. I'm hoping within 5, maybe like around 7 years, I get to the point where I really can pay for like all my life expenses with dividends. And then I would consider myself financially free. But right now, according to Qualtrim, I literally have a progress bar on this and I'm 16% of the way there. So we'll get there. It'll climb up to 20% and then 30 and 40. We'll get to complete financial freedom, but we're not there yet. We Were Creatures says, do you even lift, bro? Obviously I lift a very small amount compared to some people on the Discord, I'm sure. Look, I've been married for 8 years. I have 2 kids. I got nothing to prove. I'm not here trying to bulk up to go out to the clubs or whatever the kids are doing these days. I'm already established. I got nothing to prove. I work out because it just feels good. It releases some endorphins. You stretch your muscles out. I try to keep healthy, but I don't even look at how much I'm lifting. I do a very sissy form of working out where I work out just to feel good and keep my body in working order. How much I lift, I haven't even maxed out in like 5 years. I just never max out my weight. Whenever I lift a small amount, but I do like 10 reps, 12 reps, and I do a bunch of sets of it. So I work out until my muscles are exhausted. But yeah, I don't know how much I really lift right now. Rohan says, how much do you trust the analysis of chief analysts? I'm not going to buy or sell something based purely off of what anyone, including a chief analysis, including Morningstar, including, like a Seeking Alpha article. I will not buy or sell something based off of any one other person's recommendation. That's never going to be how this works. What I do is I have different ideas. I have different things I'm looking at, and then I'll look at the chief analysis and I'll get your opinion on it. And if somebody has a very contrary opinion, I should add Misery to chief analysis because he's very much into analysis as well. And I like him because he often pushes back on different investment ideas I have. He pushes back strongly on some of them. And that, that pushback makes me try to look at my investments and ask the questions, is he right? Is this company have things I have to look at that I haven't right now? And I might do further analysis based off of his pushback. Likewise, if one of the chief analysts is like extremely bullish on a stock, right? That might make, it draws my attention more to it. I might go, what does he see in the stock that I'm missing? And I might do more analysis on it. Like I know Rohan's very bullish on Facebook. And so that's a company I might look at and go, well, he doesn't have that many stocks. He spends a lot of time looking at them. He's extremely bullish on Facebook. And Rohan continually shares things about Facebook that are like the story playing out with this company. And it's made me consider Facebook a lot more than I normally would. I put it up in the story fund. I put it to a higher allocation. I look at the company and think, is he right on this? Is it have all these different ways to make money? Is it still have a competitive advantage? So I would say that I don't trust anybody's analysis like 100%, but I do use it to look at, it draws my attention to more things. It might give me more pushback. It makes it so that I have a more well-rounded opinion on stuff. And by the way, the chief analysis role, I've given out to people that I think they consistently offer unique and interesting and well-researched, like well-informed, good arguments on different stocks or equities or whatever they're investing in. Like Koshin's really good at real estate. If you want to have real estate questions and you want some opinions on things, he's going to have extremely good input on that. The same thing with all the chief analysts. The reason that I put them in that role is simply because they have a lot to offer with their opinions on different subjects. Doesn't mean all of them are 100% correct, but I think that they've offered better or more informed opinions than most people. And the person I need to add to that I will add to it is Misery. I actually was planning on doing that, but I just need to do it. Joe King Forever says, I think Joseph enjoys pain and suffering. He opened a can of worms with this channel. This is the question channel. Quote, Joseph, come to bed and stop crying in front of the computer. Joseph's wife promptly. Maybe this hasn't been too bad. I think the questions here have been pretty fair. I'm okay with people poking fun. I'm okay with people thinking I'm the worst, people outside of the Discord that aren't fans of mine. There's some people that they're just every way possible. They don't like me for whatever reason. That's fine. One thing I don't understand is true haters, like people that really hate me for some reason, but they watch all my videos and like they go out of their way to hate me. My question is like, why not just like not follow me and move on to something else? Like when I really don't like a different content creator or somebody that's an online presence, I don't go and like antagonize them. I just don't follow them anymore. So, but YouTube overall is great. You guys are all great. This is an amazing community. When I started the Discord, I thought that we had some cool people in the community, in the audience. I knew that there were some pretty cool people just based off the comments I got on videos. I was like, man, there's a lot of really well-informed comments here. If you take out some of the dumb trolling ones, some of the memes that people post, there's some people that post comments every time. If you go beyond that, there's a lot of them that are like pretty awesome. But the Discord community elevated that to an entirely different level. I've had to do very little moderation. There's people that are so smart in different areas. I've learned a tremendous amount just on this Discord. So it's been very interesting to see this grow. But right now, I think it's a pretty amazing community. Susing, I think that's it. The story fund is now roughly 1/4 the size of the dividend fund. To me, this seems almost like a hedge of your original methodology of dividend investing. Personally, I don't think anything is right or wrong, but why haven't you disclosed the info outside the Discord, especially to your YouTube audience? I I don't view it as a hedge. When I'm making decisions, and it's okay to think that it's wrong. If you think it's wrong that I don't like promote that portfolio as well outside of the Discord, that's fine. I can take the criticism. When I look at my passive income portfolio, I look at that as what is best for this portfolio. I'm not afraid to go into growth with the passive income portfolio. In fact, I've been heavily criticized for having too much growth companies in the passive income portfolio. So if my goal was to only focus on to balance things out or like hedge things, if my goal is to say, hey, I want to focus on dividends in this one and growth in this one, and I want to balance things out, then I wouldn't include 40% of my portfolio being growth in the dividend portfolio. And I don't look at it that way. When I look at my dividend income portfolio or the passive income one, I think, what are the best investments that fit with this type of investing philosophy? With the passive income portfolio, I'm showing a type of investment. I'm tracking a specific type of investment, which is focused on companies that they pay out passive income, they grow it over time. They're usually bigger, well-established companies, not like small cap, not very speculative companies. And that's kind of the product for the show. Looking at the story fund, that's not the same thing that people originally subscribed to. So I didn't want to create another dividend fund for the Discord. That would have fit with my original investing philosophy. But if I did that, that would make the content more limited. I would only be able to talk about dividend stocks ever. And what I wanted to do was create content on growth stocks as well. I have an interest in technology. The story fund is heavily based off of companies that I have a big interest in. So my original thought with the story fund was not to do some type of balancing act between value and growth. It was simply to open up the amount of content that I can talk about and to offer the Discord members something unique. If you guys are interested in growth companies, then I have a portfolio that shows my take on that type of investing. What I would do if I was building this growth portfolio. And I think the best way to do that is to use your own money. So I looked at it more of like a YouTube business perspective of I want to have content for both the Discord members that offers something unique and insightful. If I just had another dividend portfolio, then that really wouldn't offer something unique to Discord members. And for the original show, I have my thumbnails of that portfolio, the passive income one, on every single thumbnail. The dollar amount of the portfolio is on every single thumbnail. The Joseph Carlson show is a product, right? It's not just like an ongoing blog. It's actually a product with a show that has different segments. It has different, I structure it a different way. I edit it a certain way. I build up my passive income portfolio. That's a huge part of it. So it's something that I've considered. I think I'll do it eventually down the road. On every single time I do, by the way, every single time I show the Patreon, I have there right on the screen that part of the perks is a secondary growth portfolio. So people know I have that, as well as I respond to many comments of people saying, what do you think about this company? And I say I have it in my growth portfolio. But yeah, it's a hard decision. I don't want to make all of a sudden the channel and the format very confused and introduce this growth portfolio into a channel that's based off of this specific structure, and it has a rhythm and it has a routine and it has a whole format. And then I upset all of that format and that structure by confusing audience members and, doing all this type of stuff. So right now I've kept them separate, mostly because of just the format of the show. I'm very much I have a recipe that works. The show works. YouTube, you never know what's going to happen. If you change the show drastically, if I change the format, what does that mean? What's going to happen from it? So I feel like there's more of a risk of introducing a big change to it like that than there is just with offending some audience members or something like that, or trying to be more transparent. I feel like there's actual risk of screwing up the format of the show. Another thing I've considered is turning my secondary YouTube into an account that talks about that. And I might do that in the future. So what I could do is offer some of these Story Fund episodes as exclusives, but I show them and I link to them on the main channel. And then it would be transparent. People would know that it exists. They'd be able to see a sample size of these videos, but they wouldn't get all the content for free. They'd have to join if they want to see every episode. So that's probably the route I'm going to go. I'm going to upload all of this to a secondary channel like I am right now. You guys will have access to every episode, but one out of every 5 episodes, I'll post on the community tab of the main channel and show people, hey, here's what's like a secondary content on a growth account. And that way it would be transparent to them. I've only done that so far with 1 episode. I did it with the New York Times one. And for some reason, the community tab, I don't know, like a couple thousand people watched it, but not a whole lot. So I need another way to put it out. But I don't feel comfortable mixing my main content in with the exclusive content on the same channel. I think the YouTube algorithm is mysterious. I don't want to play around with it. I'd rather just keep the same rhythm that's been working for the past 2 years without messing around with things like that. Rage of Anarchy says, my parents have never invested outside of passively managed things like a Roth IRA. They're close to retirement. Would you recommend investing for them or not? Would you recommend investing for them? What would be good for them? If they're close to retirement, I would keep them in just index funds, really solid index funds, broad market exposure, and maybe, right now, maybe like a good value fund, one that's focused on safer companies, a little bit more conservative. Don't worry so much about the upside, but just focus more on capital preservation. So if you look at different analysis on different funds, look for ones that have lower volatility. They're focused on companies that are just going to preserve their capital and slowly grow, maybe have a little bit like, 2 or 3% yield, a little bit more than the market. That's probably what I would put anybody in that's close to retirement and has a lot of money that they want to be able to enjoy. Well, anyway, okay. I hope you guys enjoyed this. A little bit different than what we normally do here. I usually don't have the video, so that's been an interesting experience. I'll have more exclusive episodes, obviously, once I get more time to record them. If you want to have your question or your subject talked about, ask it in Questions for Joe. That's the channel. You can post any question here. And what I'll do is I'll look at the last one I covered in the previous episode, and I'll just start from the top. And if I have anything interesting to say about it, I'll try to answer it. But that's all for today. I appreciate all of you guys. I'll talk to you next time.